去。
没关系，没关系，
你就自己抓就好。
OK， 好，他们来。Ladies and gentlemen, please welcome 2003 Nobel Prize laureate, Professor Robert Engle. Good afternoon, ladies and gentlemen. I am Mingxin Liao, Chief International Officer, Donghai University. I will be your host and moderator for today. We gathered here this afternoon and with high anticipation, ready to be inspired by Professor Engle. But before we start our intellectual feast, I'd like to invite you to join our music prelude by our very own Donghai musician. They will perform the Rondo Olego Moto from Feder Kulash Trio in D major. And on flute, we have Shi Shaobai, Lian Ziyang. On clarinet, we have Lin Peini. Please sit back and enjoy. It is such a wonderful tree, isn't it? Before I formally introduce Professor Engle to the stage, I'd like to introduce some of the very important people from our community. And first, I'd like to introduce the chair of Donghai University Board, Dr. Wu Qingmai. President of Donghai University, Professor Zhang Guoen. Vice President of Donghai University, Professor Liu Zheng. Vice President and Provost of Donghai University, Professor Yang Dingya. And thank you for all joining us this afternoon. And now, please allow me a rare privilege to introduce a scholar who has single-handedly founded the field study. Professor Robert Engle is the Michael Arbolino Professor Emeritus of Finance at NYU Stern and the co-director of the Volatility and Risk Institute. And he is the father of financial econometrics. And his invention of the ARCH model revolutionized how the world understands risk. Before his work, economists treated volatility as a constant. And because of him, now we can model the swinging, turbulent nature of the real world markets. But Professor Engle is not the one to rest on his laurels. And he is using his Nobel-winning tools toward the greatest challenge of our generation, climate change. And through his creation of C-Risk, it's a measure of systemic climate risk. And he's showing to the world how that all the environmental stress has inevitably reshaped global balance sheets. And he's here to share with us that climate change isn't just a scientific problem. It is a financial one that can be measured, priced, and managed. Please welcome the creator of the V-Lab and a true giant in economics, Professor Robert Engle.
Well, can you hear me? Is this working? So, it's a great pleasure to be with you today. Thank you so much. Thank you, Mr. Chairman, Mr. President, Vice Presidents, faculty, students, honored guests. It's so terrific to be with you today. I feel a connection with Taiwan, which I want to share with you for a moment today. When I became an economist, the man I talked to the morning I made this decision was Professor Liu Dazhong, who is a Chinese econometrician teaching at Cornell University, and who also became the chief economic advisor to Chiang Kai-shek, and spent a great deal of his time here in Taiwan while I was working with him at Cornell. He was my thesis supervisor, and as a result, I have made several trips to Taiwan over the years and taught many students, some of which are teaching you. And that's wonderful for me. So it's a great deal of pleasure that I'm here. And I have some things I want to show you today. I want to show you some of the ways we measure risk in financial markets and how the risks of climate change affect asset prices. I'm going to introduce a new type of risk, which I call termination risk, and show you how that's relevant in understanding sustainability and the determinants of progress in our efforts to become a more sustainable planet. I'm going to discuss some policy options that are being considered and tried and struggling with the issue of how do you govern a planet. And finally, I'll look at some current events and predictions. So that's the agenda. So let's start with talking about the risks from climate change. The science of climate change is actually very simple, at least at its first level. When there is more energy that comes to a body than leaves it, the body warms up. And that's true of the Earth. And the reason it happens to the Earth is because the layer of greenhouse gases, primarily CO2, but others as well, form a sort of a blanket around the Earth so that the sun's energy comes through this, but when it gets radiated back out into space, the blanket prevents some of those radiations from exiting. In a planet like Venus, the greenhouse gases are so opaque that it heats up and it's a very, very warm planet. In a planet like Mars, there are almost no greenhouse gases, and so it is extremely cold. We're in between. We need some greenhouse gases, but we're getting too many. So the temperature is rising to new levels. Almost every year we have a new record for the highest temperature that's been observed over many centuries. But it's not the highest temperature that's ever been observed on the US planet. 125,000 years ago, the temperature was 1 degree warmer than our historical period. We're actually now about 1.5 degrees above that level, so it's warmer now than it was at this point in history. But the sea level then was 10 meters higher. So if we were to keep this temperature for a while, the glaciers would continue to melt, and sea level presumably would rise to something like 10 meters above where it is today. That wouldn't affect this university, but it would affect an awful lot of cities. But even before that, long before there were humans on this planet, it was much warmer even than this, and basically all the ice melted on the planet, and the sea level was about 200 meters higher, and there were great extinctions of animals at this time. You can see this from the fossil records. So one of the things that I think we should keep in mind is that by failing to deal with climate change and solve this problem, we potentially will make the planet as warm as it ever has been, and the sea level will rise to something like this. We may well make human beings extinct, but probably the planet will survive. So, how do we stop climate change? We call it mitigation. If we stop emitting so much greenhouse gases, the amount of CO2 in the air will gradually decline, and the temperature will be stabilized, and then will gradually decline back to where it has been historically. The Paris Agreement between 197 countries in 2015 lays out a roadmap for how to do this. They assert that if we can reach net zero emissions globally by 2050, we will avoid the worst damages from climate change, and we will then be on this slow trajectory back to historical levels of temperature. But we know perfectly well that the global economy runs on energy. We use energy for almost everything we do. All the manufacturing, all the transportation, communication, everything depends on energy. So we use massive amounts of renewable energy, and massive amounts of fossil fuel energy, and we will have to replace those with renewable energy if we're going to meet this target from the Paris Agreement. So these 197 countries that signed this roadmap must be thinking, how do we do this? How do we come back to our countries after signing this agreement, where we're all very enthusiastic, and put into place some kind of policy that's going to do this? Most of us are in economies where we can't actually tell people what to do. What choices do we have? When we have free markets, there is a real problem, because emissions are free, but the costs of emissions are imposed on everyone, so that it's a classic externality. And if you've studied economics at all, you know that externalities are very hard to solve in market systems. And the reason is because because of what we call free riders. So what is a free rider? A person that does not reduce their emissions, but gets the benefit that when everybody else does. And so market solutions don't usually work very well when there are externalities and free riders. So what are the government's choices to deal with this? Well, the most common ones are either to tax emissions, or to subsidize renewable energy, or to regulate emissions, either by prohibiting emissions or prohibiting cars that do emissions, or various kinds of regulations. Or I've put down the fourth one as hope. So why did I call it hope? Many times when you see a list like this, the fourth one is do nothing. But I'm thinking of at least hoping that the private sector will see this as something they want to do, and everybody will change their behavior to more green kind of activities. They will stop emitting, they will stop buying foods that are made with emissions, they will work for companies that don't emit anything, and we will, in that kind of a way, have such an upwelling of personal preferences that we might achieve these targets. I've described it in a fairly hopeless way, I guess. And that's because economists tend to think that hope doesn't really work. And the reason is really the free rider problem. We can't solve the free rider problem except if everybody agrees to do what is needed. So the politics of passing one of the first three types of legislations are fairly complicated, because all of these legislations will create winners and losers. Some companies will do well, some companies will do badly. When you try to get a bill like that passed, the companies that are being hurt tend to lobby efficiently to cancel the legislation. But of course, we need to recognize that if we don't decarbonize, everyone's going to be a loser. So we're going to have all these physical damages that we're worried about. And so the question is, how do you pass legislation like this? Well, investors are also an important part of this. Investors decide what to put into their portfolio, what companies they want to buy shares in, what companies do they want to loan money to. And if you think that there is going to be legislation like this, you might want to invest in the winners rather than the losers. And so stock prices today may reflect what investors think the possibilities for climate mitigation are in the future. Now you might say the stock market is not as smart as that, and I might have to agree with you, but on the other hand, there is evidence that we will see that the market does respond to these kinds of possibilities. So I'm going to show you, first of all, some estimates that we do at the VRI, the Volatility and Risk Institute, for various kinds of assets: stocks, real estate, financial companies, and funds that do respond to these kinds of risks of climate change. So the question is, how do you measure these kinds of risks, and how do you measure these kinds of responses? So what do we mean by a risk, first of all? A risk is a bad outcome that might happen. It's not for sure, it just has some probability of happening. If it's far in the future, we call it a long-term risk. And assets which are exposed to long-term risk are inherently less desirable than assets that are not, if everything else is equal. Why should you buy an asset that's exposed to a long-term risk? You might think you could hold it for a while and then sell it, but the person you're going to sell it to also knows about the long-term risk, so this doesn't solve the problem. So when we think of climate risks, we think typically these are long-term risks. They're events that are far in the future, or somewhat far in the future, and that the question is, can we foresee these risks? And does the market foresee these risks? So when we look at these risks, we tend to divide them into two categories: the physical risks due to actually the extreme weather that we're talking about, and the transition risks, which are, in a way, our political response to trying to reduce the physical risks. So both kinds of risks are in the market. The physical risks get stronger if we're not going to mitigate climate change, and if the mitigation is strong and successful, then the physical risks will actually be less severe. So market participants, like you and I, have to figure out, what do we do with our portfolios if we're worried about either the physical or the transition risks? So physical risks tend to be geographically specific. Hurricanes are only in some parts of each country. Droughts are only likely to be in some places. Floods are only in some places. So how do you going to benefit from this risk? Will appreciate the short part of the portfolio, which is going to be hurt by this, will depreciate, and the portfolio will rise in value. And in the same sense, if the risk goes down, the portfolio will decline in value. So you can think about this as something that an investor might want to hold if they really think that climate change is going to be worse than the market thinks it is. In other words, you might take a view that the market is wrong about how much climate change is going to be. You might also want to take the position that you don't know whether the market is too high or too low, but if climate change is going to get really bad, you want to be protected on that side. And if it turns out to go away on its own, you're happy anyway. You don't mind if you lose some money on that. So that's typically how you think about a hedge portfolio, that it's not necessarily what you are betting on the future, it's that you would like a risk reduction technique. You would like to reduce your exposure to climate risk so that if the climate really gets bad, at least your portfolio did well. Okay, so a hedge portfolio is therefore a risk-reducing portfolio, and like insurance, we expect to have to pay something for a risk-reducing portfolio. So the question is, do these hedge portfolios have negative expected returns compared to the rest of the market? And I think from a theoretical point of view, we expect that. We don't know quite how much it's going to be. But when you start trying to measure whether they have negative expected returns, of course the question is, have things changed that make these transitions more likely to occur or not? So there are two things going on all the time. There is a sort of the negative expected return, and then there's the positive return that comes from new information, for example, that the climate is worse than we thought. Okay, so that's kind of the background. Let's see how you apply that idea. So let's think about a physical risk. What would a hedge portfolio look like for a physical risk? Well, in a recent paper, we have made a stab at that, and there are other people making stabs at it. We're looking at portfolios of houses, residential portfolios, actually also some commercial portfolios. These are bundled together and sold as real estate investment trusts or REITs, and you can buy stocks in a REIT. So there are daily continuous time observations on each of the REITs that there are, and there are probably thousands of them. Each REIT has properties in a particular location, and some of these locations are high risk and some are low risk. So you could put together a portfolio which is long the REITs that are not very exposed to climate change, and go short the REITs that are highly exposed to climate change. They might be in the areas of Los Angeles where there are fires. They might be in areas of Florida and Louisiana where there are a lot of hurricanes. There are different ways that these could be high-risk portfolios. So this is a portfolio which might increase when physical risk goes up and would decrease when physical risk goes down. So we're interested in what assets are responsive to that. And the insurance companies are certainly a good example of that. So what we'll do is we look at property and casualty insurers to see whether their returns are correlated with this hedge portfolio. And we actually calculate a beta, which varies over time, on this hedge portfolio for each of a bunch of property and casualty insurers. And it turns out some of them are much more exposed to this hedge portfolio than others. So when the value of this hedge portfolio changes over time, often it's because hurricane season is worse than usual, or wildfires are worse than usual, or something like that. And that makes this portfolio go up and down. And if we see that's correlated with these insurance companies, that means the market is pricing this risk by changing the valuation of insurance companies. The ones that have taken on more risk become less valuable. The ones that have not might become more valuable as long as when we see this portfolio go up. So that's kind of the idea. And it turns out, if you actually look at where these different insurers have their right policies, it corresponds fairly nicely to the betas that we see from this statistical regression. So if you want to know what's going to happen to the insurance company, you say, well, suppose this hedge portfolio takes on an extreme value. What's going to happen to the insurance companies? Some of them will lose a lot of money, and others will only just lose a little bit. And so we can do a stress test of insurance companies to see whether they have enough capital to withstand what we think of as an extreme movement in this hedge portfolio. So that's the kind of strategy we're talking about. We do it for physical risk in this way. We're going to do it for transition risk on the next slide. So in the transition risk hedge portfolios, we think there might be several different kinds of transitions that could happen. We could have a carbon tax. The hedge portfolio for a carbon tax would really depend on emissions. If you're going to charge a tax for every ton of CO2 that you emit, companies with a lot of emissions are going to be the losers. Companies with not many emissions will be the winners. So we have a portfolio of low emission stocks minus high emission stocks. If what you think are renewable subsidies are what the policy is going to be, which is what the US chose under Biden, the Inflation Reduction Act, then it would be kind of the returns on clean energy companies minus the returns on fossil energy companies. That's a natural way to construct a hedge portfolio. Regulation to reduce emissions has an interesting effect on fossil energy companies. It can actually it will generally raise the price of fossil energy because you're going to prohibit some uses of it, and therefore it's going to be, people are going to be willing to pay more for the fossil energy they can get. So it might actually turn out to be good for the fossil energy producers. So we want to actually focus in this case on the users of fossil energy rather than the producers. And so that's what this hedge portfolio looks like. So all that being said, we now have 3 hedge portfolios for transitions, one for physical risk. Let's just look at some, we actually have a second one for some of these things, but let's just look and see what we got with these. So if we take the S&P 500, which is a universe of stocks in the US, and regress those on their returns on these transition risk portfolios and a few other and market factor from pharma French factors and so forth, and then allow the coefficients to be time varying, where we do it a year at a time, then on average, the greenest companies will be the ones which have the most positive effect from a transition, and the brown companies will be the ones which have the most negative effect from the transition. And so looking at, there are about 600 stocks that have been in the S&P 500 over the last 20 years. So looking at those 600 stocks and sorting them into the greenest and the brownest gives these 2 lists. Now these are on average, they're not specific times, and it doesn't look exactly like the list that you would imagine. They're not all fossil energy on the right-hand side, although there are a lot of industrials and a lot of energy companies. On the left-hand side, what's interesting is you see a lot of utilities, and utilities often have a fair amount of emissions, but many of them have no emissions. They might be utilities that are primarily buying renewable energy and then selling it to customers. They may be water utilities, in which case, of course, their emissions are not particularly an issue. And one of the clear things that makes utilities winners is that any kind of decarbonization is going to end up needing more electricity. Electricity is the clean energy that we're trying to produce. We want to produce it using renewable sources, but in fact, however it's produced, it's electricity that's going to be heating homes and running stoves and driving our cars in a green future. Anyway, so this is an average table, but we have it for each year, something like this. And one of the questions that people want to know is, why are some stocks, do they look greener than others do? Are there observable characteristics that the market is using to tell which one is which? And so here is my, this is my most econometric slide here. So don't worry too much about it. But what we've done is we've taken the T statistics on these hedge funds, hedge fund betas, hedge portfolio betas, and looked to see whether they're in the top 20% of green or the bottom 20% of brown at each year, and what's the probability of a given stock being in this green section or a given stock being in the brown section. And so there are 4 regressions here, which are each logistic regressions measuring a probability, and these regressions are estimated in column 2 with fixed effects for year and industry, and column 4 with fixed effects for year and industry. So what do we put in this regression? What do you know about firms when you're an investor? Well, one of the things you know about them is their balance sheet. They have to report their balance sheet. And so what balance sheet information is valuable? You also might know something about their emissions. We know their ESG scores. And when you have ESG, you've got a whole lot of different numbers about the environmental effect, the social effect, and the governance effect. That's what ESG stands for. So what is it that really influences these coefficients? And so rather than look at the table, I've got a little verbal summary on the side here. This is Rob Engel's AI, but I probably should have asked ChatGPT to do this. It would have been even better, I'm sure, because it does it so well. In any case, what makes firms green? High profit margins, low long-term debt, long-term interest expense, low book-to-market ratio, low market beta and idiosyncratic volatility, high intangible assets and high R&D, low emissions, but ESG data is not significant, and E by itself, which is the environmental score, has the wrong sign. So this suggests that there are important balance sheet data that tell you whether this looks like a brown company or a green company, but the ESG numbers are not actually very reliable in terms of predicting this. Only the emissions, which is one of about 20 characteristics which are in the E score, seem to be important. When you look at brown characteristics, low advertising, low profit margins, high interest expense, high market beta, high book-to-market ratio, low capital expenditures, and high emissions, and the E score is insignificant or significantly of the wrong sign again. Okay, so I want to come back to this narrative in a few minutes, but this is really what the market is telling us that they look at. And why would the market have these kinds of features? I think I have an answer for that. And so if you can just remember, more or less, some of this anyway, we'll see where I think it comes from. I want to do one more thing, which is banks. Professor Liao mentioned the C-risk measure, and C-risk is done exactly the same way we did individual stocks and insurance companies, but we use a different hedge portfolio. We use a hedge portfolio called a stranded asset portfolio, which is another way of trying to define what the fossil energy market is really like. And so we do an estimation of the returns on banks all over the world, regressed on this hedge portfolio and a market factor. And in fact, we do a different econometric technique. We do something called dynamic conditional beta, which is related to the ARCH model that I did the Nobel Prize on, because it says, I don't know, some of you are, anybody here take an econometrics class? You ever hear of x prime x inverse x prime y? Okay, so this is the formula for ordinary least squares. But it's got variances and covariances in it, right? And when you do least squares, you use all the data to estimate the covariance and all the data to estimate the variance. But you could estimate the variance and the covariance at each point in time, and then they change over time. And if you do that, you get a beta on each day. And so using the ARCH model, you get, or the GARCH model in this case, you get estimates of the variances every day, and using dynamic conditional correlation, which is a sort of a correlation version of it, you can get correlations every day, and so you get an x prime x as of day t inverse times x prime y as of day t. Anyway, it's quite a nice technology, and it produces nice time variation, where the time variation is really based on the data rather than on your assumption, which I used in the previous one, that let's take it a year at a time and we'll assume it's constant for the year, and then we'll assume it's constant for the next year. This allows it to be changing all the time. So what do we get? Well, we get a measure of C-risk, which is a measure of capital adequacy. It says how much capital would this institution need to raise to continue to function after a big rise in climate transition risk. So if climate risk goes up, you expect banks that have invested in fossil energy to lose money. Do they lose so much that they have to raise capital, or they have to come to the government and say, help, to prevent bankruptcy? But there's another measure we use as well, which is we call marginal C-risk, which is the difference between C-risk when there is no climate event and C-risk when there is a climate event. And so, in other words, it's a question of how much capital did this company, this bank, lose in response to the climate shock. So let's look at these. This is for Citibank. And we do this every day for, I don't know, 2,000 or something like that, banks around the world. So let's look at the bottom. The bottom curve is marginal C-risk, which tells you how much would Citibank lose if we have an extreme climate event starting at this date. And if you look at this picture, the biggest event is here. So what is that event? Well, that's the pandemic. The pandemic starts in early 2020 actually it's high just a little bit before it, but it continues through here. And the pandemic was a time when we stopped driving, we stopped flying. Fossil energy companies were struggling. Their stock prices fell, and there is a big exposure effect to the banks that held the loans to them because their loans started looking more and more fragile. 5 minutes till I'm over? Okay. Well, okay. The top one looks at the marginal C risk, and it shows that Citibank needed to raise capital during the pandemic, but they also needed to raise capital later. What happened later? We had inflation, and they were not prepared for inflation. And we had some banks failed because they had treasury bonds, which they thought were safe, and then when interest rates went up, these bonds went down in value, and they had to fail. Okay, here's the same thing for the US as a whole, and it looks kind of like it does for Citibank. Here's the whole thing for China. And one of the things you see about China is the inexorable rise in C risk. But that is due to the fact that the Chinese banks are undercapitalized increasingly. And, well, they're state-owned, so they don't fail, but they don't have enough capital by our measure. Here's what it looks like for the world as a whole, which in fact is dominated in this case by the Chinese banks because they are big and they have a big capital shortfall. And finally, here's Taiwan. So it looks like in Taiwan, the same kind of picture is there. You see the capital shortfall during the pandemic, and then another one during the high inflation period. It's only like $60 billion, whereas the others were in the trillions for the world. But this is something that regulators all over the world can look at. So, what have we learned? Well, we've learned that many firms and assets are exposed to climate risk, and if the climate continues to get worse, the brown firms are going to be less and less profitable until ultimately they would go out of business. And this would be true no matter which of these termination risk strategies were used. We would still expect fossil energy to ultimately, or the brown firms to ultimately shrink and go out of business. So I want to change from looking at what investors do. You know, I'm sorry, but I'm not going to be able to finish in 2 minutes. So we're going to have to renegotiate this, okay? Okay, I'll hurry though. So I want to talk about termination risk. I mean, termination risk is something new that we constructed. And what is termination risk? Termination risk is the risk that your company is going to go out of business sometime in the future, and but it's not too far in the future, but you don't know when it's going to be. And the question is, how do you manage a company like that? What should you do? And for one thing, we don't really know the answer to that because we don't teach that at business schools. We only teach you how to expand your company. We don't talk you how to manage a decline. But there are lots of companies that decline. And so here is my slide on termination risk. This is the dodo, which of course is extinct. And let's look at it. So I want to talk about a luxury beachfront hotel. And this beachfront hotel is going to be destroyed by sea level rise, because it's down right on the beach, and it's really a lovely location, but sea level is going to destroy it. What are we going to do? How do you manage it? And this is sort of like horse carriages or vacuum tubes or Kodak, rayon, tobacco, floppy disks, Blockbuster, and many other things. But we also think it's going to be like fossil energy. So here is an example of such a hotel. This is a hotel called the Engle III, and my parents were engaged in that little tower, and it was destroyed, although not by sea level rise. How should we manage this hotel? If you think this is going to happen, well, you might sell it, but you're not going to get much for it because everybody knows it's going to be destroyed by sea level rise. You wouldn't, however, want to add to it. You don't want to put a new addition on if you've got a payback period which is longer than you think your termination period. So you might not invest as much. And you might even not do maintenance that would be routine if you think that the termination is fairly soon. And you might not pay taxes either. So there are ways that you would reduce the supply of rooms. And if other hotels are doing the same thing, then the aggregate supply might go down and the price would go up. So you might imagine that this hotel looks moderately profitable because it doesn't have to do any investment, it doesn't do so much maintenance, and it gets possibly good rental rates. So would you ever buy stock in something like this? This hotel, the stock is going to go to zero when termination hits. Would you buy the stock today? And fortunately, finance has an answer for us. Yes, it has cash flow. It's that the value of the stock is the present discounted value of all the cash flows that are going to happen between now and the termination date. So if termination is pretty soon, that means a low price. If it's late, then it means a higher price. And there would be a risk premium probably on top of that. So if we look at a hotel like this or another industry, what would we expect to see? We'd expect to see low price earnings ratios if there's not many years left, low price to book ratios as the market value is likely to be less than the book value, high expected returns to the stock because risk depresses the value, and declining market capitalization, because if you've only got the present discounted value till the termination date, that gets to be a smaller number as you get closer. How does that happen? Well, what is going to happen is the hotel is going to pay dividends and maybe buy back shares. And both of those things decrease its market value and pay off the investors. And so by the time termination comes, investors will have gotten what they expected, and the stock price will go to zero for the only shares that are still outstanding, and then the hotel will own the shares. So this is kind of what the picture is. It might be changed. If demand goes up, then earnings will increase, but you wouldn't expect a lot of supply response. If the owner of the hotel decides he wants to continue by diversifying into some other business, the stock market tends to not like that. They don't like you to diversify in things which are not related to what you're doing. They would rather diversify themselves because the investors can diversify with their portfolio. They don't need you to do it. And unless you're really good at it, they'd prefer to do it themselves. Finally, some hotels might cut their prices to increase their market share on this beach. And if so, you'll have a price war and it'll make everybody worse off. So a solution to that might be for one of the hotels to buy its neighbors. And you might expect to see consolidation. That doesn't increase the total supply, but it does improve the way you function. So these are what you might expect to learn in a business school class about how to manage declining industry. So does fossil energy really look like this? Does fossil energy seem to have termination risk? Well, this is the picture of what's supposed to happen to the energy sector, and it's supposed to go to zero by 2050. So if you believe this picture is going to happen, then you've got to believe that there is a risk of termination. You don't have to be confident this is going to happen, it just might happen. What do we see when we look at the data? We see coal going down, we see petroleum is actually peaked in 2005. This is US data. Natural gas, however, is increasing, and renewable energy is increasing. If you look at the recent period, you can see nuclear is more or less constant. Coal has been decreasing, but actually has a little blip up here in 2025. That's what Trump has done. But it's predicted to drop back down again. And if you look at the top, you see that energy is increasing, but the main part of the increase in 2025 is solar. And so this is a picture which does not really correspond to what we think is happening in the US. There is some promotion of coal, but not particularly of natural gas or oil. Well, oil is not used for electricity much. The market cap of these fossil energy sectors has basically been declining since 1980 with some ups and downs, but it's a much smaller part of the economy today than it used to be. If you look at price earnings ratios as of last week, the lowest price earnings ratio is energy. The highest is technology. If you look at price to book ratios, the lowest is energy. The highest is technology again. If you look at dividend payments, almost the highest is energy. They're paying out big dividends, and their long-term debt to equity. I didn't say anything about the debt market, but you wouldn't want to lend long-term to a company that's going to go bankrupt in the near future, so it's not surprising they have less long-term debt relative to their equity than most of the other sectors. If you look at the number of rotary rigs outstanding, this is declining. If you look at actually anywhere in the world, it seems like the number of rigs is declining. If you look at mergers and acquisitions, I don't know whether you call the US government capturing Venezuela as a merger or an acquisition. It's sort of an acquisition, I guess. But they're trying to persuade oil companies to invest in Venezuela, but it's not really clear that they're going to do that or that they even want to do it. In 2023, ExxonMobil purchased Pioneer, Chevron purchased Hess, Occidental purchased Anadarko, and the newspapers write these as descriptions of the growth of the fossil energy, but these are also terminations. All the right-hand side companies are being terminated at this sale, and the left, they're consolidating really more than expanding. So these do not require expanding supply. So what are the implications? Well, the first, Trump's efforts to support fossil energy and coal in particular have not been very effective in raising PE ratios or price-to-book ratios. Although they've increased, they're still the lowest of all the sectors. Oil and gas outputs have increased slightly, leading to falling energy prices, but gas is not. The basic idea is that termination risk is a real risk that firms face. And no matter what the president says, they're preparing themselves for a more austere future, I think. And climate silence will not stop climate change is kind of a message. We are not talking about climate change in the US anymore. It's been scraped from websites everywhere. The NSF is not funding it. NOAA is not being funded. Climate research is not being funded. But the climate is going to continue to evolve. And these companies, I think, know that. So, what happens to sustainable investors? Well, it turns out if you look at the one-year returns, which is the Trump's first year, we follow a bunch of sustainable funds, 150 funds. The average return was 27%, and the average Sharpe ratio was just a little bigger than 1. This is very good compared to, like, the S&P itself. If you looked at 5-year statistics, the average return was 6%, not nearly as good, and the Sharpe ratio was 0.2, not so good. If you look at the top funds in our list, the top fund made 163% return last year. It's a critical materials ETF. Next one was 123, next one was 75. These all have very high Sharpe ratios, so this actually was a very good year for sustainable funds, in spite of what our president is doing. It turned out that this year 103 out of 150 had positive CAPM alphas, whereas in the 5-year return, only 13 out of 120 had positive CAPM alphas. So this actually has been a good year for funds. So, okay, global climate politics. You don't want to hear about this, do you? You do? So countries can be free riders, and the US has chosen to be a free rider. They've canceled all their climate regulations, they've canceled the incentives, and one free rider makes other countries think free riding is a good idea. So the horrible thing about all this is if you're not going to cooperate, then the whole cooperative arrangement is going to fall apart. And so the question that I want to ask here is there a better solution based on cooperation than what you can have based on self-interest? Everybody working in their self-interest is going to lead to nobody decarbonizing. But in a cooperative solution, you can get to a better outcome. But how do you get that? In a country, you can have a carbon tax. You can't have a world carbon tax. We don't do that. There's nobody to enforce cooperation. So how can you do that? And I'm just going to give you, one thing is cooperate on other things and see if it works. A second thing is to do what we're doing today, which is collaborating with academics to move the electorate and move governments. Speaking out, saying what we think is important, and sharing with other people. But I also think multinational corporations have much to gain from cooperative solutions and can influence governments. There can also be climate leaders. And I have a little section on climate leaders which talks about California and BlackRock as being leaders. And I'm going to skip over that because, well, I'm just out of time. But in any case, both of them have pushed decarbonization, and they've pushed it in a way which, to some extent, has hurt them. Certainly BlackRock was sued for fiduciary failure to its customers by using ESG to measure, to design portfolios. State of California is hurt by people moving out because the tax rate is too high to cover these kinds of expenses and so forth. But climate leaders is one possibility for how to get cooperation. People step into the breach and they decarbonize themselves in spite of the fact that not everybody is doing it. They hope they have followers. If the followers do it, then all of a sudden decarbonization becomes easier to do, it more ubiquitous, and the world can actually reduce the total physical damages. But it's dangerous for a climate leader to do this. So here, California and BlackRock, so there's some economic reasons to collaborate. One is the falling cost of renewable energy, which is going to make decarbonization an opportunity rather than a cost for many countries. And the demand for power for AI is a second reason why I think that we're going to see a lot of renewable energy, because it's cheap, it's fast to be, you can put it in place rapidly to meet the rising demand in AI, and it should be able to tolerate their intermittency of solar and wind better than many other applications. People say, no, you can't, but really, if you're training a big AI machine and you need a zillion computer hours, and you can get negative electricity rates when the sun is shining and pay a lot at night, why don't you just buy more during the day and less at night? I mean, I can't believe that AI machines especially can't figure this out. Anyway, well, China is doing all this. Here's an example of a solar farm that China is doing. This is a picture of this, and here on the left is the size of Manhattan. So these solar fields are bigger than Manhattan. They're producing vast amounts of solar energy. All around the world, solar panels are helping people who don't have access to electricity from any other source. And even in the US, we see there are lots of new installations. All the yellow dots are solar plants that are expected to be done by next October. All the green ones are wind farms that are going to be done by October. The brown ones are natural gas, and you can see there are some brown ones being built, but mostly what you see on this chart are solar and wind. And then there's some battery facilities which are purple, and you see them everywhere because we're investing in batteries for backup on the renewables. And finally, there's coal, and I don't see any black dots on here for coal. So we're not building any more coal-fired power plants. We're building a lot of renewable energy, and this is in a time when our administration is really pushing for fossil energy. Here's the future according to Trump. It's the golden age of LNG, and they're building LNG terminals all around the Gulf of Mexico or the Gulf of California, depending on your orientation. But it isn't clear this is the right side of history. So, will we stop climate change? I am an optimist and believe that ultimately renewable energy will be so desirable that it will dominate our energy supply. I think the economic policies of the Trump administration will be damaging to the US and to the rest of the world and will be reversed and revised after the consequences are realized. Last week at the World Economic Forum, the risks were on display. The captains of industry will see that deregulation and lower corporate taxes and massive deficits are not sufficient for national prosperity. So I'm expecting help from corporations. The electorate will re-embrace climate mitigation as climate disasters rise, and I can only hope that this will all occur in time to repair international relations and reduce both climate and geopolitical risks. So this is 3 of my grandsons wondering what on earth is in their future. They're looking at a calm lake, a beautiful lake, pristine, and will it be like that? Will they have a good future? They are very worried about it. But if we can tell them we have it solved, they'll be very happy. Thank you. Thank you. Thank you.
Thank you, Professor Engle, for that really illuminating lectures on the financial dimensions of the climate risk. And now let's move to the panel discussion session.
Okay,
Yeah.
good. Sorry I'm over time.
No problem.
But
I think we are pleased.
We'll deal with it.
And we are flexible. Yes. And we'd like to invite our panelists to the stage. First, I'd like to invite Professor Dong from our Department of Finance at Donghai University. I also like to invite Professor Gao Yingfen from National Central University. And she's a former student of Professor Engle. All right. And since we have a lot to think after this is such an inspiring talk, so I'd like to start with something light. Shall we?
Okay.
All right. And as I prepare, I found a very interesting parallel between the mentor and the mentee. And then I think many of you know that Professor Engle has a lot of passion for ice dancing. And he is a competitive ice skater, right? And I also found out that Professor Gao is an accomplished potter as well. So my question for both of you is that in the field as intense as financial management, risk management, and how important it is to let it be on the ice or on the potter's wheel to keep our mind sharp, to have the tactile art form to cling to. So to keep our mind sharp, so the discipline of the physical, does it help with the discipline of the mind? Please.
You want to?
Thank you for having me here. I'm excited and delighted to be part of this event. And as a Professor Engle's former student, I think he should have a privilege to answer first. Would you like?
Sure, but go ahead. Just tell me what you told me at lunch today.
Okay. All right. Okay. He gave me the privilege to answer first. Okay. Actually, I do the pottery since 2009, and because our school have a ceramic club, and I still doing it every Thursday night. For almost 70 years now. And so actually this process of pottery actually allow me to have a space where I can let my thoughts freely flow and do what I want to do without worrying about rigorous and anything when it come to mind, and I can just make it in my work. So when I spin on the wheel, I actually just focus on what I see, and so when I look at the clay, I just concentrate it, and I never think about maybe some paper I have not done or finished yet. So I'll just leave it tomorrow, and then I will just do what I'm doing at the present time. And I think I enjoy that kind of process, and it did help me to do better research when I have such kind of outlet to escape from the rigorous and the logic required from the research. So that's what I think about having a hobby. It's really good, and it's better to even make it as a part of your life. Yes. Yeah.
I couldn't agree more. I think we all face the question of how do we balance our lives? How much time do we spend on our research and teaching? How much time do we spend with our family? How much time do we do things on our own? And I think if you can't solve that problem, you're not going to be a good academic. You really have to recognize that it's all important and fit it in. And if there's no conflict about saying, if I had more time, I could get more research done. It's true, but ultimately, would it be better? Would it be sustainable in the sense that you do it for as many years? I mean, we're still enjoying our research, and that's partly because we've got balance, I think.
Thank you. I think it's really important to have the work-life balance. We learn from both of you. Thank you. And next question, we'd like to move to Professor Guo, and I know you have a very important question about Taiwan.
Right. Professor Engle, you are talking about green funds and brown funds. Those green funds are who are more profitable or large company who are able to handle or spend money to deal with climate risk. In Taiwan, I want to ask a question for in Taiwan here. Although we have large companies here, but many companies in Taiwan are medium or small size companies. Okay. And how those medium and small companies to deal with or handle this climate risk? Because those medium, small size firms normally think long term, but for your short term, but long term risk is a climate risk. What do you think about it?
Well, a lot of people think about how expensive it is to build renewable energy. I think of it a different way. If renewable energy is profitable, everybody's going to want to do it.
Right.
How do you make it profitable? Mm-hmm. Well, one way is to reduce tax benefits that the fossil energy has. Another way is to tax emissions. And all these policies that I talked about are ways of making renewable energy profitable so it doesn't take public money to do it.
Right.
It's just private money. It's investors saying, yes, this is a good deal. I'm going to build a solar farm or a wind farm or something like that.
Right.
When Microsoft needs a data center, what do? They build something, and if they build something which is renewable, it's cheaper.
Right.
Why don't they just do that? Well, I think that's kind of what they're trying to do, although they bought 3 Mile Island and they're talking about refurbishing the nuclear, but anyway. So I would rather think about the question about how do you change the economics so renewable energy is a profit center,
Right.
and let the market do it.
Okay. Right.
And
All right.
small firms can do that even better than big firms because
Okay.
they just, you can start putting these out. We have, I'm sure you do too, parking lots where they've got shade structures which
Right.
are solar panels. And all of a sudden, they put charging stations there for the cars. I mean, that's just a small company doing that. But you can multiply that all over the place.
Right.
All right. And I think we wanted to leave some time for our audience. So I'd like to ask like one last question. I think Taiwan, and you talk about there are 4 strategies and for climate change, talking about taxes and subsidies and regulations, and the last one, hope, right? And Taiwan just passed the carbon fee this year. So we are charging like 300 NTD. That was about $9.50 per ton for the major emitters. Do you think that amount is enough to send out a clear market signal for Taiwan? We started this year.
I don't know. Is it?
Yeah.
Is it? Is it enough?
I think it's kind of cheaper, right, compared with the European standard, the EU standard. It's quite low. Yeah. So as we getting ahead, then
Yeah. I mean, Taiwan doesn't have oil.
No.
Taiwan,
No.
you don't have coal, do you?
No.
So you're going to have to import everything.
that's right.
If you build solar, you don't have to import anything. So the question is, what's it cost to import oil? And what's it cost today? Well, it's a little bit cheaper today because the price has come down. Actually, we're trying to flood the market with oil to get the price down, I guess. But solar panels, do you import them from China? Do you buy their solar panels?
I think a lot of solar panels are actually made in Taiwan. Yeah.
Okay.
Yeah.
Well, that's even better. Then, why isn't that profit maximizing decision? Why does it take any public money at all?
All right. So I guess that would be for some of the business owner to think about what would be more profitable.
Right.
Definitely, that's a direction to go.
That's it's more profitable and it's less risky because the price of oil goes all over the place. And if you build something that uses oil or natural gas or whatever, you've got this uncertainty about what the cost is going to be. But the sun's going to shine anyway.
Yes. So President Chen, we need to have more solar panels on campus, right? All right. And can we move on can we open the floor to audience? Do we agree or do you have other questions to ask?
I have a small question.
Okay.
Concerning this, regarding the policy makers, because they are very important as well. Many companies may be reluctant to deal with climate risk because maybe, say it's so expensive, everything to upgrade the facility. So how the policy makers, give incentive or what's the role of the policy maker towards this climate risk? What do you think about it?
So one of the places where climate risk really shows up, and I didn't really emphasize it, is in insurance policies.
Okay.
So if you're trying to insure a house or a business property or something like that, and your insurer decides, well, say it's this beachfront hotel. What do you suppose insurance costs for a beachfront hotel, which could be destroyed at any time by a hurricane? Well, if you probably can't buy it for the replacement value, but if you could, it would be astronomically expensive. Insurance is one of the signals that the risk is high.
Right.
And if you can reduce the risk by putting the house on pilings or whatever, or moving to another house that's more inland or something like that, then that's a monetary value to you that's being reduced. And you can actually do this as a cost-benefit problem for yourself and for your company. And that's one of the things about adaptation, which is kind of what we're talking about here,
Right.
that it's a natural question, what does it cost and what is the benefit?
Right.
And if the benefit is greater than the cost, you should do it.
Right. Right. Thank you. That's true.
All right, and now we'd like to open the floor to all the audience. And so if you have questions, and please raise your hand and speak to the microphone. And I'm sure that Professor Engle will be very happy to answer your questions. Please. Please. And state your name and your affiliation, please.
Thank you. Thank you, Professor Engle. I'm from東海University. I teach in the Department of Economics. And, well, one of the questions I had was, I was wondering about the risk of moral hazard when it comes to, you were speaking earlier about climate hedge portfolios. And I imagine the customers for these kinds of portfolios would be the brown industries or even the banks that face the so-called C risk that you mentioned earlier. And just as a concrete example, I'm imagining, for example, a bank investing in fossil fuel, and they buy this hedge risk, this hedge portfolio. Would this, or is there a possibility that this would make their behavior, expose themselves more to fossil fuel industries because now they're hedging against this risk? And what would that mean? Yeah, if you could speak about this. Thank you.
So I'm not sure I got the first part of the question.
Sorry.
Yeah. So you're asking what makes banks lend to fossil energy?
No, basically, is there a risk of moral hazard in this case when financial institutions buy or invest in these hedge portfolios? Would they, for example, engage in more hazardous climate-wise investments because now they're hedging against the risk of climate change? So they'll engage in behavior that, thank you.
Okay. I see. So if the bank holds some of its assets like a hedge portfolio, which would mean that they're long some green stuff, and I'm not exactly sure how the bank would be short loans to fossil energy, but say they could do that, then would that make them more likely to invest in fossil energy?
That's right. Yeah. Just as an example.
Probably.
Yeah.
Probably. But on the other hand, they're currently, if they hold this hedge portfolio, they're currently short fossil energy. So they're, in a sense, they would then could bring themselves to neutral by taking some long position in fossil energy. And then they would still have the green part of their portfolio that would be long. I don't know. My feeling is that what you're saying, it makes sense, which is you think about the bank as being a portfolio, and I think the beta that we get out of this is the beta on the whole portfolio of the bank. Its loans, its assets, its location, its business model, and all those kinds of things are all part of what's being evaluated by the market when they give it a beta. And so I don't know that a bank would be better off making loans to fossil energy and then taking an equity position in a hedge portfolio than some other kind of business strategy.
They are altogether not lending to the fossil fuel.
Okay.
Right?
That's an interesting question, yeah.
Okay, thank you. Yeah, others might want to ask.
Yep.
Thank you.
Thank you, Professor.
So and we have Professor Sims, and you have a question, please?
Good afternoon. My name is James Sims. I'm the Dean of the International College here. I like to think about it from a different perspective, if you will. We're a university, and most of our students are young. Most investors, let's say their termination date is closer from an individual point of view than younger people. Younger people maybe do not have the funds or resources to invest, and they feel kind of helpless, or they don't see how they can affect. What advice would you give to the younger generation who will actually have the longer termination date?
Can you give me a...
You say for the younger generation, their termination, when from their perspective, they feel like a termination day is far off, but they have a less resource than their parents' generation. So for them, they feel like the termination day is far. Can you explain one more time?
Basically, everything you've talked about today are for people who it means, all right, or companies with means. But for the younger generation, younger people, they do not have the same kind of resources, financial or money-wise, all right? And they might feel like their future is out of their control. What advice would you have for the younger generation?
Okay, so you think this affects their voting behavior? And you think that's why Trump got elected? Yeah, interesting. Well, I mean, political science is all over these kinds of questions, and they're spending a lot of effort trying to figure out why Trump got elected and why he got reelected after being found guilty of all these felony crimes and all that sort of thing. And a lot of young people feel out of power. They feel like the world is going crazy and there's nothing that they can do about it. I think that is true, but they're certainly not being helped by Trump, I don't think. And so I'm kind of thinking that pressure is actually might turn around to go the other direction in the midterms. Yeah.
All right, thank you. And I think because of the tying of the interest, and we should move to the next part. And so if you have a fuller question, okay. All right, okay, the short one. Then we will have the last question. Okay. And can you speak to the microphone, please?
Sure. Thank you, Professor Engle. I enjoyed your speech today. A quick question is that, have you ever heard of any investment company such as hedge fund, they might doing like climate risk neutral trading strategy to generate positive return, like what we might have learned in standard investment textbook? Like traditionally, we may like pursue beta neutral arbitrage strategy, but have you ever heard of someone doing like climate risk neutral trading strategy to generate positive return in investment industry? Thank you.
So when you talk about risk-neutral investment, are you talking about, basically an arbitrage strategy or something like that?
Yes.
And I don't know, how does that relate to these issues? Because really, these are not obviously risk-neutral investment strategies. They're supposed to be risk-reducing, and so of course can go any direction. I mean, the world is full of people who are trying to do risk-neutral investing, and I mean, I think a lot of them make money. But I don't think it's related to climate. I don't know, do you have an idea how to do a risk-neutral climate trade?
No, but maybe like I can do research in the future to.
That's good.
I mean, most of these risk-neutral strategies are short-run. You know, it's some, put-call parity or something in the options market or something like that, and they, you might expect to hold it for a week or two, but not for a decade. And these kinds of strategies would probably only be risk-neutral over a long horizon if you wait till the risk either is realized or isn't realized. I mean, that's kind of what happens. There is a risk, but when the end point happens, then the two sides offset each other, and you got into it without putting any. You got paid at the beginning, and then it's got zero value at the end, something like that. I don't have a good idea for you.
All right, thank you. And due to the time constraint, we'd like to move to the next section for that. And in recognition of Professor Engle's extraordinary contribution to the economics, and then for his gracious visit to our university, and we have the honor and to confer upon him the honorary professorship. So we now like first invite President Chang to the stage, and we will take a group picture together, and then later for the certificate and then the gift. You stay on the stage with the panelists, please. Thank you for the. Yeah. We can stand and then we can take a picture together. 一起照相。
往上，你要不要进来？
All right.
Should I take my microphone off?
Microphone? Okay, yes, yeah. All right, and now we'd like to present our certificate. And then a commemorative gift to Professor Engle, and I think we also have a commemorative gift to Professor Engle. Yeah. All right, now we want to take a big picture, a big group picture. So we will all return to the seats, and the photographer will come to the stage and take one from here. Before we conclude, I also want to thank our chairman of the International Peace Foundation, Mr. Morris, for his effort to bring Mr. Engle to Professor Engle to our university. Thank you so much. All right, and that concludes our lecture today. And we prepare tea receptions, and also we have our exhibit in the first floor of this building. And so please feel free to stay, and you are all warmly invited to go to the tea sessions. And also we have an exhibit in the first floor. Please enjoy the art. And thank you all, and then thank you, Professor Engle, for such a wonderful talk, and we really learned a lot. Thank you so much.